Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of Why CAPM Matters, Insights for Smarter Investment Strategies. Single Period Investment Horizon. CAPM operates under the idea that investors plan their portfolios within a single fixed period. Whether that's a year, a quarter, or some other time frame, all investment decisions are assumed to focus on this one window. At the end of the period, the portfolio is re-evaluated and decisions are made for the next period. What does this mean? It simplifies calculations, focusing only on returns expected for a defined time frame. This assumption ties into CAPM's goal of making risk-return predictions straightforward. However, real-life investment horizons vary. Long-term investors might blend multiple periods into their strategy, while day traders think in minutes or hours. The single-period focus of CAPM might not account for how strategies adjust over time or how decisions today could affect future periods. Think of driving a car with a fixed GPS route for a single trip. If the road ahead changes due to construction, this approach can be limiting. Similarly, in investing, a multi-period perspective might give a clearer view of risks and opportunities. By assuming this fixed horizon, CAPM keeps its calculations simple, but may not entirely reflect the complexities of dynamic investment planning. Applications of CAPM in finance. The Capital Asset Pricing Model, CAPM, isn't just theoretical. It has real-world applications across various areas of finance. Investors, companies, and financial analysts use it to make better decisions. Whether it's constructing a portfolio, valuing assets, or deciding on capital investments, CAPM plays a central role. Here's how. Portfolio management. How CAPM helps optimize portfolio selection. Building an investment portfolio is like solving a puzzle. Each asset must fit in a way that balances risk and return. CAPM provides a framework to identify which pieces belong. By using CAPM, investors can evaluate the expected return of each asset relative to its risk, measured through beta. This helps determine which assets are worth including in the portfolio based on their contribution to overall performance. Diversification decisions. CAPM guides investors on mixing assets with different betas. For example, including low beta stocks can stabilize portfolios during market downturns. Risk tolerance adjustments. If you're a conservative investor, CAPM helps identify investments that align with low-risk preferences. On the other hand, risk-tolerant investors may use it to find high-beta options that offer greater potential rewards. Since CAPM assumes a linear relationship between risk and return, its insights help investors create efficient portfolios that maximize return for a given level of risk. It simplifies a complex process into actionable steps, making it easier to choose assets that align with your financial goals. Valuation of assets, using CAPM to price stocks and investments. Ever wondered why a stock is priced the way it is? CAPM is one tool analysts use to figure out whether it's fairly valued, overvalued, or undervalued. It calculates the expected return for an asset, helping compare its actual price with its intrinsic value. For instance, let's say a stock is offering a return lower than what the CAPM formula suggests given its risk. This could mean it's overpriced, as investors aren't being compensated enough for taking on risk. Conversely, if its return exceeds the CAPM expectation, it may present an opportunity. Some ways CAPM assists in valuation. Assessing fair value. CAPM helps analysts determine if an asset's price reflects its risk-adjusted potential. Stock comparisons. Investors can compare stocks with similar betas and check which ones offer better risk-adjusted returns. Cost of equity. CAPM provides the cost of equity, a critical part of valuing businesses using discounted cash flow, DCF, models. By grounding these evaluations in empirical metrics like beta and market risk premium, CAPM offers clarity. It ensures that asset valuations aren't just guesswork, but are tied to measurable data. Corporate finance decisions, applying CAPM to capital budgeting. In corporate finance, big decisions often revolve around one question: is this investment worth the cost? CAPM is a key tool in answering that. It helps companies determine the cost of equity, a vital part of assessing whether a project or investment delivers adequate returns. Cost of equity is the return shareholders expect for the risk they're taking. CAPM calculates this by factoring in market conditions, the company's specific risk, beta, and the risk-free rate. Once the cost of equity is known, it becomes easier to decide whether a project or investment is financially viable. Here's how CAPM contributes. Capital budgeting decisions. When evaluating investments, CAPM helps calculate the discount rate to assess the net present value, NPV. If the project's returns exceed the CAPM-derived cost of equity, it's likely worth pursuing. Debt-equity mix analysis. CAPM aids in understanding how equity financing, costlier and riskier, compares to debt financing. For publicly traded firms, this influences decisions on how to fund expansion projects. Risk assessment for projects. CAPM identifies specific risks associated with projects or divisions by estimating beta. This knowledge helps adjust expectations accordingly. Think about CAPM as a financial compass. It shows firms whether they're heading toward profitable decisions or veering into riskier territory without sufficient reward. In doing so, it ensures capital is allocated efficiently, maximizing shareholder value. Limitations and criticisms of CAPM. The capital asset pricing model, CAPM, plays a major role in finance, but it's far from perfect. While it's widely used for estimating returns and assessing risk, it makes several assumptions that don't always align with how markets and investors function in the real world. Critics also highlight its oversimplified approach, which has prompted alternatives to emerge. Real-world market conditions. CAPM looks great on paper, but markets are messy in practice. The model's assumptions about how markets and investors behave often fall short in real-life scenarios. Assumption of market efficiency. CAPM assumes all markets are efficient, meaning prices already account for all known information. In reality, inefficiencies exist. Insider trading, unexpected shocks, and even human emotions can lead to mispriced assets. When these disruptions occur, CAPM's predictions may not hold up. Investor behavior. CAPM assumes investors are logical and always aim to maximize returns while minimizing risk. Sounds ideal, right? But psychology often gets in the way. People panic sell during downturns or chase trends in bull markets. This irrational behavior isn't factored into the model. Single period focus. CAPM assumes everyone plans investments over a single time horizon and then reassesses. But investors don't all operate on the same schedule. Someone planning for retirement may have a much longer horizon than a trader focused on quarterly returns. This short-term focus can distort CAPM's real-world usefulness. Risk-free rate reality. A risk-free investment like a treasury bond is a core piece of CAPM. But even government bonds carry inflation and interest rate risks, challenging the idea of a truly risk-free benchmark. Simply put, CAPM simplifies a chaotic world. But when those assumptions stray too far from reality, its applications lose accuracy. Alternative models to CAPM. CAPM provides a baseline for understanding risk and return, but critics argue it's too narrow. Several alternative models have been introduced to address its weaknesses and offer better ways to evaluate investments. French three-factor model. This model goes beyond CAPM by adding two extra factors, size and value, to market risk. It recognizes that small-cap stocks often outperform large-cap ones, size factor, and value stocks offer higher returns than growth stocks, value factor. These additions improve the accuracy of return predictions. Arbitrage pricing theory, APT. Unlike CAPM, APT doesn't rely on a single market index. Instead, it accounts for several macroeconomic factors, such as GDP growth, interest rates, and inflation, to explain returns. This allows for more flexibility, but requires more data and effort to use. Carhart four-factor model. Building on the Farmer-French model, this approach adds momentum as a fourth factor. Momentum reflects the tendency for assets that performed well in the past to continue performing well in the short term. It's a practical addition for investors who factor in recent performance trends. Behavioral models. Some newer approaches try to incorporate irrational behaviors like overconfidence or herd mentality into pricing models. These aim to capture the unpredictable side of markets that CAPM ignores. Each model aims to correct or expand on CAPM's limitations. While CAPM is a starting point, these alternatives offer insights that fit real-world complexities better. So which is best? It depends on your purpose. Every model has its trade-offs. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.